Hello investor, I Raj Mantri from Concept Investwell. Today we will discuss about capital gain. Any profit or gains made from sale of capital asset is known as income from capital gain. Such capital gains are taxable in the year in which the transfer of capital asset takes place. There are two types of capital asset: short-term capital asset and long-term capital asset. An asset which is held for a period of 36 months or less is known as short-term capital asset. Long-term capital asset, an asset which is held for a period of more than 36 months. However, there are some exceptions. An asset would be qualified as short-term capital asset if it is held for a period of 12 months or less, such as equity shares or preference shares of a company listed on a recognized stock exchange in India. Securities such as debentures, bonds, government securities that are listed on a recognized stock exchange in India. Unit of mutual fund, whether quoted or not. Unit of UTI, whether quoted or not. Zero coupon bond. And another exception is that asset would be qualified as long-term capital asset if it is held for a period of more than 24 months, such as immovable property like house property, land or building. Now we will talk about the taxation on capital gain. In case of short-term capital gain, in case when the STT, that is security transaction tax, is paid, then the applicable rate would be 15%. In other case, the applicable rate would be normal slab rate. In case of long-term capital asset under section 112A, in sale of equity shares or unit of equity oriented mutual fund or unit of business trust, the applicable rate would be 10% over and above rupees 1 lakh. In other cases such as zero coupon bond or unlisted equity shares or immovable property, the applicable rate would be 20%. In case of zero coupon bond, it would be lower of 20% with indexation or 10% without indexation. Now we will talk about the grandfathering clause. The grandfathering clause under section 112A provides relief from long-term capital gain from sale of equity shares or unit of equity oriented mutual fund that were acquired before 31 Jan 2018 by modifying the purchase cost as if they were purchased on the same date, that is 31 January 2018. So for example, if Mr. Udit made a lump sum investment in a equity shares of a listed company on June 2005 for say 20 lakh rupees, the fair market value of those investment on 31 Jan 2018 is rupees 40 lakh, and Mr. Udit plans to redeem those investment at rupees 43 lakh in May 2019. The net gain he is making is of rupees 23 lakh. However, the capital gain would be on only 3 lakh, that is 43 lakh minus 40 lakh. Now we will talk about the recent amendment to Finance Bill 2023, in which the gains from debt mutual fund would be taxed at normal slab rate and would be considered short term irrespective of their holding period. Thus, the investor will lose their indexation benefit. Now we will talk about the set-off part, in which long-term capital loss could be set off against long-term capital gain only. However, short-term capital loss can be set off against both long-term capital gain and the short-term capital gain. Now we will talk about the dividend taxation. Earlier, dividend received from a domestic company was exempt until March 31, 2020 because the companies and the mutual fund were paying dividend distribution tax before declaring such dividend. However, Finance Bill 2020 has changed the method of dividend taxation. Now, dividend received on or after April 1, 2020 will be taxable in the hands of shareholder or the investors. The dividend distribution tax liability on the companies and the mutual fund shall stand withdrawn. The Finance Act 2020 also imposes TDS on dividend distribution by companies and the mutual fund on or after April 1, 2020. The normal rate of TDS on dividend income is 10% in excess of rupees 5,000 on companies and the mutual fund. Any person who has paid TDS on dividend can claim it by filing their income tax return. Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.